So hello and good evening, everyone. My name is Bimal Master. I'm the Chief Mentor for IMS in Mumbai. And I welcome you to this special webinar titled Value Maximization, Corporate Objective and Managerial Compensation. This webinar is part of an initiative by IMS called Management Masterclass, a sneak peek into the management pedagogy. As most of you would be aware, this initiative is a result of our constant endeavor to impart and enhance our students' knowledge. Right, so we've conceptualized these sessions so that our students get a first-hand experience in B School pedagogy by the expert faculty members on different subjects being offered in an MBA course. Right, so attending these webinars is similar to attending an introductory B School session on that given topic. Right, so it will help you get a gist of important subjects and help you be equipped in making better decisions or better selections for your MBA courses. So let me talk a little bit about the topic for today. Right now, the value of any firm, right, is measured by calculating the present value of cost flows of profits of the firm over a number of years in the future. Okay, therefore, the value of the firm or shareholders' wealth is given by the present value of all expected future profits of the firm, and managerial compensation is seen to be the result of a market-based mechanism which ensures that managers have adequate incentives to maximize shareholder value. So, this is something that we will be discussing with the help of, I believe a case study also that our eminent speaker today has laid down for you, and I think it was shared with you as a pre-session reading material as well. Right. The key takeaways from today's session will be, first of all, understanding why shareholders' wealth maximization is the preferred corporate objective. What are the limitations of value maximization objectives, conflicting interest of stakeholders, agency costs, and things like that, as well as ESOPs, right? So, what are the ways to reduce the agency costs? So to throw more light on this exciting subject and to present his perspective on the topic, I'm pleased to invite Dr. Himanshu Joshi, the Professor of Finance and Accounting at FORE School of Management. With over 2 decades of experience in teaching, training, and research, Dr. Himanshu is currently working as the Professor of Finance and Accounting with FORE School of Management, New Delhi. He's also associated with IIM Rohtak, IICA Manesar, and ONGC Academy, Dehradun as a visiting faculty. He's developed and conducts various executive education programs for corporates and PSUs on spreadsheet modeling for valuation, enterprise risk management, foreign exchange risk management, and financial strategies for value creation. He frequently publishes research papers in peer-reviewed journals of national and international repute. Speaking a little bit about the institute that he represents, FORE School of Management is a private business school located in South Delhi. The B School is ranked 43rd among the top management colleges in India by NIRF in 2021, that is last year. The school is known for its PGDM courses in international business, financial management, big data analytics electives. Right? Apart from PGDM and MBA course, the college also offers executive MBA and a fellowship program, the FPM program. So it is wonderful to have you with us today, sir.
So welcome to this class, that is value maximization, corporate objectives, and managerial compensation. I hope some of you have read this particular case that I've shared with you, very brief case study, which talks about a dilemma of a guy who is just passing out from the B School and has two options. One is the option to join an MNC company as a management trainee, and the other option he has of a startup company, which is a small company, but giving him very steep learning opportunity, right? So if you are in position of this particular guy, Rohan, what is your take? What will be your decision? Would you prefer to join the MNC or the startup? So I'm just explaining this to you. So it's a talk about a guy, Rohan, who is very happy today because he's getting two placement offer actually. One is from his dream MNC as management trainee, and the other one is from the startup as a senior team leader and a partner. Now, Rohan is confused between the two offers because MNC is offering him very good opportunity to work in a very well-structured organization with best of line training and international work opportunity, as well as it's a very branded name, reputed company. But when you talk about the startup, it's a new company, but there is a steep learning curve. He will learn a lot of things in the startup in all the functional areas, be it marketing, be it finance, be it HR, and it provides some very quick growth opportunity to reach the top level very quickly. While in the MNC, the path to leave the top management will be quite difficult and quite long path, right? Now, beside this joining option, that is whether to join the startup company or the MNC, Rohan is also confused about the compensation packages that are being offered to him. Now, when we talk about MNC, it is offering two type of packages. Now, first package is you have 15 lakh rupees per annum as your salary, right? And the 80% of your salary will be fixed component, that is certain component that will be getting, while 20% will be the bonus, and that bonus will be linked to the net profit of the company in that particular year, right? So if company is earning substantial profit, 15% of the rise will be given based on the net profitability of the company in that particular year. That is first option. If you look at the second option here, it says that 60% of your salary is fixed and 40% of salary is actually employee stock option, ESOPs, which is nothing but right to buy stock of the company at a future date at a fixed price. So you can buy stock of the company at a price which is fixed today, but at a future date. For example, you can buy stock of the company after 3-year time period. And they will say that, fine, you can buy stock of the company at rupees 500. Whatever be the price that time, you can buy at 500 rupees. It's an option for you, right? So company is mentioning this package as 80 lakh rupees per annum. That means if you choose the second option here, this option is giving you 3 lakh rupees in addition to the first package. So he's confused that which option he should choose, whether he should go for the first option, which is 15 lakh, but 80% fixed salary and 20% bonus, which is linked to the net profit of the company, or the second option, which is having 18 lakh salary, 60% fixed, 40% in employee stock option, that he can buy stock of the company later on at a fixed price. The limited number of shares are being given to him, right? Now, on the other hand, the startup is also offering the same type of package, and it is giving you even larger component of employee stock option. It is saying that you will get fixed salary, very small amount in comparison to what is offered by the MNC. It's just 8 lakh rupees per annum. Definitely, the startup companies are not that cash rich, so they try to save as much as cash possible, but they try to make the compensation more attractive by offering ESOP, employee stock option. So this company is saying that you can buy the stock of the company when this company gets listed on the face value itself. That is, if one share of rupees 10 each, you can buy 2,000 shares of the company at rupees 10 each from the company itself. That is the second option here, the startup one, right? So while he's having two options, MNC and startup, and 3 compensation plan to evaluate, he wonders about certain things here. First of all, the first question, that is whether to join MNC or the startup. Next question is, if he joined the MNC, which is more likely because all the colleagues are doing the same, which compensation package he should opt for, the first one or the second one, right? Now he's confused here on certain aspects. For example, first option is clear. If the company is more profitable, it will give him higher bonus. So he's quite okay with the first option, but second option, he's quite confused. He's wondering that why his option exercise price, that is price at which Rohan can buy equity share after 2 years, is 25% higher than the current market price per share of the company now. That is, suppose we say that the stock price of company is 400 today, right? Company is saying that after 3 years, you can buy stock of the company at rupees 500. So he's seeing no benefit. I mean, if I pay 500 to buy the stock of the company and the stock price today is 400, I can't buy today. I will buy after 3-year time period. He's confused at why such option is being taken as a compensation package, right? He's thinking about it very loud. And then the third question that is wondering him is, he thinks critically about the startup offer also and wonders how startup can offer the compensation which is linked to the stock price, because startup is not yet listed in the stock market. There is no share of the startup in the market as such. There is no IPO being offered now. But it is saying that when IPO will come, you will get right to buy a share of the company at rupees 10 per each. That is your book value per share. right? So he's confused that which option to choose, which, first of all, which company to join and which option to choose as far as compensation package is concerned. While understanding all this, he's quite confused that, okay, why the modern corporate organizations are putting too much emphasis on the price maximization, stock price maximization, and why they're trying to link the compensation with the stock price. That is the concern here, right? So this is the brief idea about this particular case. Okay, let me explain you very quickly that why it is so important for corporate entities to maximize the stock prices. First of all, if you are doing any activity, you must have an objective, right? Your objective can be maximize the market share of the company. Many e-commerce firms are focusing upon that objective. Just focus upon market share maximization. That means you capture more and more customers. Forget about the profitability as of now. You burn the cash, no problem, but you focus upon expansion of your market so that you become the dominant player. You can see this happening in the e-commerce war. Amazon, Flipkart, everyone is trying to, first of all, capture the larger share of the market so that they become the dominant player. That can be one objective. Few firms which belong to old economy, they focus upon simple objective of profit maximization, that I should focus on profit figure, right? While most organizations in the world market now focus upon the maximization of the shareholder value. That is what you call the stock price. What is shareholder value? Very simple. It is nothing but market price per share into number of outstanding share being traded in the market, being traded in the stock market. That is what you call market capitalization. So if you maximize the market price per share, your value of stockholder will maximize, right? So what are the advantages of using stock price maximization as an objective? First of all, stock prices are most observable of all measures that can be used to judge performance of a publicly traded firm. Simple example. Suppose I say, if the company is launching a new product, right? How much time will it take to reflect the new product launch, its good performance in the product market, and this is getting reflected in the financial performance of the company? How much time will it take? Suppose you say the company is Tata Motors, which is launching many new products in the market, the automobile segment, right? That is your passenger car market. And the product are being accepted by the market quite well, right? So how much time will this new product launch and acceptance by the market will take to get reflected in the balance sheet, in income statement of the company? It will take at least a quarter, if not a year. Now, if you talk about the profitability, it can take 2 years also, 3 years also, because you are launching a product, it will take some time to understand the market, then market will respond, and then you will start getting good realization revenues. It will take a lot of time. But the moment you say that something which is impacting or getting impacted very positively on the announcement of a new product is what? Stock price, right? So any information about the company, if it is good, it will get reflected in the stock price immediately. And if the information is bad about the company, again, that will also get reflected in the company stock price immediately. So it is one of the most quickest measure to just check that whether this decision of my company has been taken by the market positively or negatively, right? While financial performance, that is your annual report, your quarterly results, will take long time. So whether I'm doing right or wrong, right, it will reflect in the stock price very, very quickly. That is why managers prefer to use this as a measure of corporate objective, not the profit maximization, not as the earnings management kind of thing. They focus purely on the market price per share maximization. Another advantage here is that new product launch, you can always link with the performance of the company, because when you launch product in the market, you're earning revenue through these products. But there are some very important information which are critical for your company, but you cannot convert those information in monetary terms, in money value. You can't convert. For example, Suppose the CEO of the company or the CFO of the company who has developed this company from the scratch quit to join another company. Now, can you assess the impact of this decision of the CEO or CFO in terms of monetary benefit or monetary loss to the corporate entity easily? Is it possible? No. Right. But how will this get reflected in the stock price? Immediately. The moment you say that the CEO who started this company is leaving, you will see that stock market will react immediately. Stock price will fall immediately. So there are two advantages of using stock price here as a corporate objective. First of all, it is a quick reflection of all the action company takes. It is not taking much time, right? Other thing will take at least a quarter to reflect this information, but it is very, very quick measure. Second thing, whether the information is qualitative, for example, CEO joining another company, right? Or quantitative, right? For example, the new product launch, the increase in inflation, increase in interest rate by the government, all these are quantitative information. You can model these things out. But if it is even qualitative, for example, war in Ukraine and Russia, maybe US is also joining. So if this kind of information is there, you're observing the market is crashing today because the war is a bad news for the world economy. So this is also reflecting even non-monetary information very quickly. So it's a quick measure and reflect all the action taken by the corporate entity and reflect the world economy, domestic economy, as well as industry dynamics very clearly, very quickly in itself. That is the advantage of using the stock price as the corporate objective. Next is the important objective here. Stock prices in a market with rational investor reflect long-term effect of the firm decision. Even if market is doing some error in the estimation, this error is better if you talk about the long-term value than a very short-term focus on the precise information. So for example, if you're just focusing upon the quarterly profit, quarterly earning per share, or quarterly earnings of the company, that won't give you much weightage. What is important here is that if investors of the company are focusing upon the long term, right? Just take a simple example, right? I think we all have observed different type of IPOs in the recent past. One IPO was a well talked about IPO, Zomato. And what was the premium on the day of listing? It was substantial. Don't give the number. It was substantially listed on the premium. Zomato was actually going up on the day of listing itself. Now the other stock was Paytm, having other story, different story. Stock price fell immediately on the listing, right? So point is, why stock price fell on the date of listing for Paytm and why it rose substantially in the day of listing for Zomato? Because stockholders are not focusing upon the very short term. They understand the business model properly and they focus upon the company's long-term future. So probably they think that Zomato business model is quite successful in the long run, even if company is a loss-making entity. Zomato is not a profit-making entity. It's still burning cash of the stockholders. Still, they think that it's a dominating player in the market, and it will reap good benefits if you hold stock for long term. That's why stock price is going up on the day of listing itself. But the Paytm, because we have a lot of players now in the market which are in the payment banking system. We have Google Pay, we have Phone Pay, we have a lot of players, and any upscaling of the Paytm is not quite visible in the market. The market actually punished the stock price of the Paytm by reducing it on the day of listing itself. So they're not focusing upon the cash flow. Probably Paytm would be more profitable in comparison to Zomato as far as the hard cash flow is concerned. But you're not focusing upon that. You're focusing upon the dominant position of the company in the product market. That's why the stock price take long-term view of the company, not the short-term view. And the last one that is quite important, the stock price is the real measure of stockholders' wealth. When I say real measure of stockholder wealth, it means that you can very easily calculate it. There is no difficulty in computation. Simply do one thing: market price per share multiplied with number of share Yash is holding in his Demat account. Suppose Yash is holding 1,000 share of ITC and the stock price today is 200 rupees. You can just multiply 200 and 1,000. You'll get, okay, fine. What is the valuation of my share? That is 2 lakh rupees. So it's very easy and quick way to calculate. If stock price move up from 200 rupees to 300 rupees, the wealth of Yash will increase by 1 lakh rupees easily, right? So very easily measurable thing is your stock price. That's why it's a very quick reflection of all the action. It is focusing on the long term, not the short term profit, and very easy to compute the valuation of the wealth you are creating by investing in the stock market. That's why it is one of the most preferred measure of the corporate objective. This is the basic structure we are observing where stock price maximization work. Now look at this. We have two things to focus upon. If you are an employee of the company, right? If you're working for a company, is it easy to work for a company as an employee 9 to 6? Or it is easy to become stockholder of the company by just buying some stock from the market? Which is easier option for you? Don't you think the company is doing a wrong thing to focus too much on the stockholder wealth maximization? Anyone can become stockholder by buying stock of the company, but anyone cannot become the employee of Google or Amazon. So should you not focus upon the employees more than the stockholders? Why should not you value your employees more than the stockholders? But would you bring any money to the company if you buy a stock from the secondary market? If you're subscribing to IPO, then money is flowing to the company, that is for sure. But suppose Yash is buying stock from Ayush or from Karan, then do you think that company is benefiting from that? Right? We cannot ignore the employee. So point here is not just employee. I'm talking about employee because I've discussed a case of compensation, which is linked to the employee. And we're talking about the stockholder and the employee. But if you look at the larger picture here, a lot of stakeholders are there in the company, in a corporate entity, not just the employee. Definitely, we are keeping the stockholder or shareholder on the top, right? We're keeping them on the top. But we also have managers who are managing the company, right? Which include the employees also. So I think they're at the center of this entire decision-making process. It's not the stockholder who are at the center, it is the managers. We are keeping them at top. But who is managing all the affair of the company? It is the professional management team, right? Then companies also borrow money from the market. So there are bankers who are giving credit to the company, they're giving loan to the company. At the same time, we have bondholders. If you don't want to raise money from the banks directly, you can raise money from the capital market by offering debentures and bonds. So these bondholders, they're not stockholder. They simply get fixed interest from the company regularly. They have bondholders also. And every company is creating or destroying something in the society also, right? For example, do you think ITC is a FMCG company? So do you think it is a good FMCG company or not? So they have a very good product line, right? As far as the products are concerned in the FMCG market. What are the competitor? HUL, Patanjali, Procter and Gamble. So a lot of companies are there. But if you look at the stock price of ITC, it is much lower in comparison to these firms. Reason, very simple, because ITC create a cost on society, while HUL is not in the same league. What cost ITC is creating to society? Right? Still 80% of the profit of the company, rather revenue of the company, come from cigarette business. Now, cigarette is a social evil. People know that it is causing cancer, right? So tobacco companies are not valued that much as the other FMCG companies like HUL. Their valuation is much stronger in comparison to the ITC because they do not create such severe social cost, right? They're not impacting the society in negative way, but ITC is doing so, right? So definitely, we are not supposed to focus upon a single stakeholder, that is your stockholder. We should focus upon the society at large also. That is important, that whether I'm creating some value for the society or I'm creating some nuisance in the society. So tobacco company is definitely creating a nuisance by selling those products which are injurious to the health of the people. Right. Similarly, we have financial market also, wherein we are a different type of player. Investors are there, and investor can be retail investors like you and me, and it can be some investors which are very large mutual fund companies, FII we call them, foreign institutional investors, right? So these are different stakeholders. Our objective should be that there should not be any conflict amongst the interest of these stakeholders, right? We should not do such things which is misappropriating the interest of one stakeholder at the cost of the other. I mean, you're benefiting stockholder by cheating the bondholder. That should not happen. If that is happening, then your company is probably doing a wrong thing. You should not create social cost for benefit of the stockholder. You should not cheat your employees. You should not earn more profit by reducing salary of your employee. If you do so, definitely in the long run, your company will not survive. Right? A simple thing is that if you pay lesser salary to your employees, what will happen? In the short run, what will happen? Your profit will go up. Right? So it's a choice to decide that whether I should focus on short term or long term. So your key employees, your talent will leave your company. You won't be able to retain them. And if you're not able to retain them, you can't create value in the long run. So any company which is not focusing upon the employees can definitely not grow in the long run. And you can't create even the stockholders value in that condition. So point is that we have to set cordial relationship among all the stakeholders. We should not have any conflict between the stockholder and the bondholder. We should not have any conflict between the manager and the stockholder. Similarly, no conflict between manager, stockholder, and society. We should not produce anything which is injurious to health of the people. If it is so, in that case, definitely the society will punish us in terms of the decline in the stock price. Similarly, we should reveal right information honestly and on time to the financial market. We should not fudge our account. We should not do window dressing. We should not inflate our profitability. We should give picture very clearly to the market that what is happening. And we also expect that stock market is absolutely efficient in reading this information. Then in that condition, we believe that the stock price maximization function will work perfectly fine. That means, what is the condition here? Stockholders are the owner of the company, but they are not taking part in the day-to-day decision making of the company. For example, Yash Khatri can buy 1,000 shares of Reliance Industries, but you won't join the board of company by buying 1,000 shares. So how do you participate in the decision making of the company? Actually, when you buy a stock of the company, you are invited to attend the AGM, annual general meeting. In annual general meeting, you have right to appoint the board members. Of course, your voting is actually one share, one vote. And Mukesh Ambani is having 49% share of the company. So definitely whatever he will say, that will be accepted. That's a different point. But point is that still you have some right to say. You can always give your vote in favor of or against the appointment of some board of directors. So you have power to simply appoint and fire board members and the managers as stockholder. If you use your power judiciously in that condition, you will not allow managers to create conflict between your interest and their interest. Otherwise, manager will always try to put their own interest over and above the interest of the stockholders. Now, let us discuss one more. We have discussed about stockholder and manager conflict. We can also discuss about the manager and society. For example, the case of ITC. Let us discuss one more important conflict, the stockholder and bondholder conflict. Very interesting example I'll give you here. I think we all know Tata Motors. So here, this company is well known. Now, this company did some significant decision they took in 2008. Can you tell me what that decision was? 2008 Tata Motors. They acquired JLR. Now, very interesting thing I'm giving you here. The Tata Motors was very strong financially before the acquisition of JLR. Right? The credit rating was AAA. Credit rating is nothing but what is the repayment capacity of the firm as far as the bondholders are concerned. If company is taking any loan, right, from the public or from the market, what are the chances that this loan will be returned back to the public comfortably? So higher the rating, more are the chances that you will return this money comfortably because you have a lot of money to return this money back. That was the rating actually. So AAA rating is very strong rating. And this rating depends primarily on 2-3 things. For example, what is the total debt of the company as far as total assets are concerned? So lower the amount of debt, more is your credit rating. Second important thing is what you call interest coverage ratio. Again, very simple thing, nothing to worry. How much profit you earn and what is your interest payment due. So if you earn 1,000 rupees of profit and your interest due is rupees 100, are you comfortable in that case? You're earning 1,000 rupees of profit, but your interest due only would be rupees 100. It's comfortable position, right? But suppose you earn profit of rupees 100 and your interest is also 100 rupees. So are you comfortable then? No, right? So higher the interest coverage ratio, for example, in the first case, your interest coverage ratio was 1,000 rupees of profit and 100 rupees of interest you're supposed to pay. In second case, your interest coverage ratio is 1:1. Whatever is the profit, this entire money will go in the interest payment. You're not getting that much comfortable there. Okay, so when you talk about this company, which is very comfortable in terms of low debt in the capital structure, low debt as far as total assets concerned, and very good interest coverage ratio. They're earning substantially higher than what they're supposed to pay as interest. That was the Tata Motors, right, before 2008. But they took a decision to acquire JLR. And this JLR acquisition happened on the route of what you call LBO. You will study this thing when you come to management class in finance, leverage buyout, right? So leverage buyout means that you take huge loan to acquire a company. That's what your LB route is. And how do you try to repay your loan? Simply, if I'm acquiring JLR, I'm expecting that JLR is a going concern. It's a good company. Whatever profit or whatever cash flow I will earn from the JLR business, I will use those cash flows to repay what loan I have taken. But what will happen initially when you are trying to amalgamate the Tata Motor and JLR together, the Tata Motors debt level because of this loan taken will go up substantially, right? Your interest coverage ratio will drop significantly. So what will happen? The credit rating of Tata Motor that was AAA in 2007 dropped to BB in 2008. That means your repayment capacity has dropped significantly. Now, tell me one thing. Is it a good news for the debt holder or bad news? Very bad news, because higher the credit rating, lower interests are being paid to them because they're safer. So if you are having AAA rating, you're paying just 7% interest rate. But if the rating dropped to BB, you are supposed to pay 12%. But unlike your stock market, the return to bondholder is not fluctuating like that. If you have bought the bond and this bond is saying that fine, it will be okay for 10 years and that will pay you 7%, irrespective of what the credit rating of the company is, you will still get 7%. But your riskiness has increased now manifold because it has dropped from AAA to BB. So whose benefit it is? It's a cost to the bondholder, but whose benefit it is? To whom I think this is benefiting? The acquisition of JLR, stockholders and the managers, right? Because managers think that if they acquire a global company, it will increase their brand value. Stockholder thinks that long run, the Tata Motor will be able to produce better products because of technology transfer between JLR and the Tata Motor. That is what we are observing now. And now launching very good product because of the technology transfer, right? So long-term objective is of managers who are staying with the company as employees. Long-term objective is with stockholders who are buying stock of the company for long-term. And they will earn, they will reap any benefit company will earn if the company remain more profitable. But the bondholders are not at all concerned about these things. They're just looking for two things. Give me my interest, what you promised, without exposing me to further risk. So you're still giving them 7%, but the risk has now increased from AAA rating bond to BB rating bond. Your rating has gone down. They are now they're not exposed to much higher level of risk than before. It's a conflict of the bondholder and the stockholder. So point is in this case is that the conflict, if it is there, then stock price maximization function will not work. It will not work if there is a conflict between manager and stockholder, if there's a conflict between bondholder and manager and the stockholder, if there is a conflict between stockholder and society. For example, the ITC is creating conflict here. It's creating cost to society by producing something which is harmful for the people, that is tobacco. And we can always talk about another company which created the cost to financial market. Have you heard about the companies called Enron, Satyam Computers? So what was the issue with Satyam? So what they were doing actually, they were fudging information. They were not revealing information honestly and on time to the market. They were trying to mislead the market by giving them wrong information, right? So this is again a conflict. So point is that we should keep the interest of all the stakeholders into our mind, and then you focus upon maximization stockholder wealth, then this function will work perfectly fine. The moment you have a conflict between two stakeholders and you try to focus upon stockholder wealth maximization, it means that you're hurting one stakeholder for the benefit of the other guy, which is not accepted at all. So this entire case discussion that we started was actually on simple compensation. So why do you think this compensation is being linked to stock price? Why we are linking with ESOP? Simple reason, to reduce the conflict between the stockholder and the managers. Because otherwise, manager will try to put their own interest above the interest of the stockholder. They will use private jet to travel. They can travel in economy class, but they will use private jet to travel. Again, we have stories of that sort also in our context. For example, the stories about Vishal Sikka, the ex-CEO of Infosys, who used to travel from Bangalore to Seattle in private jet, while Narayana Murthy still is traveling in economy class, but he was traveling in private jet. So it was creating cost to the stockholder, right? Now, how to align the interest? Simply don't offer that kind of perks to the CEO or the manager. Offer them ESOPs. Ask them, if you want to maximize your own profit, please maximize wealth of the stockholder. You give them right to buy stock of the company at rupees 500, which is now just rupees 400, so that they put their efforts in that direction, that stock price goes up and higher than 500. It becomes 1,000, 2,000. So higher it goes up, higher it is more it is beneficial for the stockholder, and more beneficial it is for the managers. So they will benefit, and they will also create value for the stockholder. That is, how do you reduce the conflict, or how do you reduce the agency cost between the different stakeholders? So we are discussing one small aspect of this concept, that is, how do we reduce conflict and agency cost between stockholder and the managers? That is by setting managerial compensation in such a way that we are linking it with the stock price performance in the long run. But we can also have discussion on stockholder, bondholder, stockholder, manager, right? Manager, society, financial market and company. So we can resolve all these conflict by using different kind of governance practices and different kind of agency cost minimization tools.
All right. Then I think, Dr. Joshi, we can end this session. So thank you very much. It was very interesting, very informative. I'm sure it has been of immense value to our students as well. So thank you once again for taking time out from your schedule and addressing our students.
Thank you. Thank you for the invitation. Thank you very much.
Thank you. Guys, so that's all that we have for today. Thank you for joining us, and see you once again in the next exciting edition of the Management Masterclass. Thank you.
Thank you.